Welcome back, students. Here we are with the new video, that is money market instrument. So what is a money market instrument? It is a financial instrument which is having very short-term maturity period, basically less than 1 year, and it is a tool used for raising capital with the money market instruments. And these are very basically debt securities, and they offer a fixed rate of interest, and they are generally unsecured. There is no collateral backing up the security, and the risk of non-repayment is theoretically high. Not actually, you can say theoretically it is very high risk because it is not backed up by any collateral securities. However, money market instruments have high credit rating, ensuring that issuers don't default. Whoever are issuing this money market instrument, organizations, bank, and all, they are very good, having very good credit rating with them. So that will act as an backing up for investing the money. So moving further, what are the features of money market instruments? In first, the most important one is high liquidity. Basically, this money market instrument act as a high liquid financial assets because they are less than 1 year and maturity period is also very less. This character of money market instrument are considered as a close substitute of money because easily converted into cash within short period of time. And it is a secure investment because where you are investing and the issuer is always having the high credit rating, and that act as a backing up, and you will be assured that your money will not be losing. You will not lose your money because you are investing in a high credit rating companies. Now moving to third one is a fixed return. Yes, initially we discussed about meaning that you will get a fixed rate of interest on this money market instrument, and some are even on the basis of discounted value to the face value. And the amount that the investor gets on maturity is decided in advance, that is nothing but the face value. And if you see, there's all three aspects: high liquid, secure investment, fixed returns. This is a basically an investor look to invest within short period of time. Now, why actually the reason behind money market instrument? So maintain liquidity in the market. So to function the economy in the country, money market liquidity is the most important part where money market instruments helps or securities helps. So it maintains the liquidity in the economy, and even RBI uses these short-term securities to get the liquidity in the market within required range also. Now coming to the second point, provides funds at a short notice. When these organizations require immediate money, so they can issue this money market instrument, and which is an excellent opportunity also for individuals, small and big corporation, banks, of borrowing money at very short notice. You can get it in within short period of time. And utilization of surplus funds. Any you can say any organizations or anyone having the surplus funds which is disposable, and any investor is looking for that surplus fund, and they can invest in money market, which is very liquid in nature, and earn significant profit on the same also. It facilitates investors' savings into investment channels. These investors include bank, non-financial corporation, as well as the state and local governments who uses this money market instruments. Now moving further, aids in financial mobility. Financial mobility act as an most important part in the economy. The growth of economy is dependent on the mobility of the finance. So what happens here is one sector to another sector, you can transfer funds easily whenever fund is required. And moving to fifth point, this helps in monetary policy that we have already discussed. A developed market helps RBI in efficiently implementing monetary policies. So transaction in the money market affects short-term interest rate, and short-term interest rates gives an overview of the current monetary and banking state of the country, where RBI decides what type of monetary policies has to be framed. And this further helps RBI in formulating the future monetary policy. deciding long-term interest rates and suitable banking policy also. Now let's see which are the different types of money market instruments are available. And the first one is treasury bills. We also call it as T-bills. And these are issued by the uh, Reserve Bank of India on the behalf of central government for raising the money. So these are very short term in nature and up to the 1 year. And the basic maturity periods are 91 days treasury bills, 182 days treasury bills, and 1 year treasury bills. So they are issued at a discount rate, and at the maturity, the investor will get the face value, which is quoted by the issuer. And coming to the commercial papers, these are issued by the large companies and big businesses, and they issue this promissory notes to raise the capital to meet the short-term requirement of the businesses, and also known as commercial papers. And these firms have a high credit rating, owing to which commercial papers are unsecured, with companies' credibility acting as security for the financial instrument. So, credit rating of the companies is plays most important role in the commercial paper. On that basis, these short-term instruments can be used, basically commercial papers. So, a third one, certificate of deposits, and these are issued by the banks and financial institutions. They are having fixed rate of interest rates on the investment amount. And the primary difference between CD and a fixed deposit that the value of principal amount that can be invested. The former is issued for large sum of money, and you can 1 lakh or in multiples of 1 lakh thereafter the initial investment. And because of the restriction on minimum investment amount, CDs are more popular among organizations that individual who are looking to park their surplus for short term and earn interest on the same. So this is the best opportunity for them to earn the profit also, and it helps the banks and financial institution to meet the immediate requirement of the money. Now in the fourth one, a repurchase agreement, that is also called a repo. Repurchase agreements are, or even we call buybacks, and these agreements are a formal agreement between two parties where one party sells a security to another, and there will be a promise that after a certain period of time they will buy back the same security after later date, and the specified date we can say from the buyer. And it is also called as a sell by transaction. At the end, that is the fifth one, bankers acceptance. And this is an financial instrument produced by an individual or a corporation in the name of the bank is known as bankers acceptance. It requires the issuer to pay the instrument holder a specified amount on a predetermined date, which ranges from 30 to 180 days, starting from the date of issue of the instrument. And it is a secure financial instrument as the payment is guaranteed by the commercial bank. So these were the all money market instrument today we have seen. So thank you.